Hey everyone, welcome back to Corporate Decoder. Today we're diving into Sinclair's latest annual report, and let me tell you, this one's got more plot twists than your favorite soap opera. Will they pay off their debt? Will their old school broadcast model survive the streaming wars? Let's find out. Sinclair Inc. is a massive media company. Maybe you know them best for their local TV stations. They also own the Tennis Channel, some digital media companies, and even dabble in things like real estate and venture capital. This report covers their performance for the past year, ending December 31, 2024. Now, a quick but important note, this report contains what are called forward-looking statements. Basically, they're trying to predict the future, but as we all know, the future is never certain. These statements come with risks and uncertainties, so keep that in mind as we go. One of the biggest risks they mention is the continuing decline in cable TV subscriptions. More and more people are cutting the cord and switching to streaming services, which could seriously hurt Sinclair's revenue if those streaming services don't carry their channels. They need to make sure their stations and content are part of those new ways people watch TV. Speaking of getting their channels carried, Sinclair also faces the challenge of renegotiating deals with cable companies and streaming services. If they can't get good terms, or if networks demand a cut of those fees, their revenue could take a hit. It's a constant battle for them to get fairly compensated. Another regulatory headache, retransmission consent. This is the legal stuff that lets Sinclair charge cable companies to carry their channels. Any changes to these rules could mess with their business and bottom line. The rules change is beyond their control, but it affects their money, so it's a risk. Like any big company, Sinclair is always looking for new opportunities, making acquisitions and investments. However, these ventures come with risks, especially if they need to borrow money to finance them. If they can't handle the debt, or if the acquisitions don't pan out, it could cause serious problems. Sinclair faces fierce competition for viewers and advertisers. They're up against other broadcasters, cable networks, streaming services, and even tech giants like Google and Facebook. It's not all about the numbers, people matter too. The report also mentions the risk of losing key people, including on-air talent. If they can't keep their stars happy, it could disrupt their operations and hurt their financial results. Sinclair's advertising revenue is like a roller coaster, up and down depending on the election cycle. Presidential election years are huge, but other years can be pretty slow. The more interest around elections, the better their revenue, so a calm year is bad. Because Sinclair operates TV stations, they're heavily regulated by the Federal Communications Commission, also known as the FCC. These regulations dictate pretty much everything, and these rules affect their flexibility. Any change in these rules may affect what they can do, including make money and reduce costs. Okay, now let's peek at the financials. In 2024, Sinclair's media revenues reached $3.511 billion, pretty impressive, but a jump from $3.106 billion last year is thanks to big boost from political ads. Looking ahead, they're planning capital expenditures between $83 and $86 million, mainly to keep their stations up to date. As of June 2024, the market value of their publicly held stock was around $542 million. It's worth noting that as of February 2025, there were about 42.6 million shares of Class A common stock outstanding. The FCC also has rules about how many TV stations Sinclair can own in certain markets. These rules are always changing, and there can be a threat to how they're approaching broadcasting in certain locations. Here's a curveball: environmental regulations. Some of their facilities might have hazardous substances from previous owners. While they say they're in compliance, future regulations or climate change legislation could cost them big bucks. Sinclair's betting big on next-gen TV, a new broadcasting technology. They've invested a lot in developing it, but there's no guarantee it'll pay off or if other people will use their patents. The technology is in the early stages, so there's no guarantee of it working out. Sinclair has a ton of debt, over $4 billion. That could affect their ability to invest in new opportunities or even just keep the lights on if things get tough. However, they are proactively addressing it. In February 2025, they refinanced a lot of their debt, pushing the maturity dates further out, but interest rates can change, throwing another wrench in the gears. Here's a quirky twist: the Smith family controls most of the voting power in the company. This could lead to decisions that benefit them but not necessarily other shareholders. Their interests and public investors might be different. Finally, these giant companies have certain accounting rules and must show that they are following them. Management, including each of Sinclair's and SBG's chief executive officer and chief financial officer, has concluded that, as of December 31, 2024, Sinclair's and SBG's internal control over financial reporting was effective. That's good. Digging deeper into this report, a few things stand out. They are focused on rolling out next-gen TV, something that could modernize the way they transmit. It could support all kinds of wireless models, data exchange, and even revolutionize things like distance learning. Sinclair seems to be making a real effort to give back to the community. I am seeing a bunch of philanthropic campaigns such as Sinclair Cares, and that is a big plus. They are also doing things like giving to local charities and awarding scholarships. From a management and organizational perspective, there seem to be some good things going on. I saw policies that are trying to support employees and be ethical and safe, which is something that I would expect from a business like this. One of the key risks is the political and regulatory landscape. With a new Trump president, for example, there may be scrutiny regarding the company's corporate social responsibility practices, and new SEC disclosure rules may be abandoned. After reviewing this report, I think that Sinclair is facing some significant headwinds. The old broadcast model is changing rapidly, and they're trying to adapt with new technology and streaming efforts, but it's a tough battle. The high debt load is a major concern, and that Smith family has a lot of control over their company. While the company did address some key issues and had a boost from local initiatives, I am skeptical that it is enough to get them to calmer waters. It is hard to be bullish on this one. Thanks for watching. If you enjoyed, please subscribe, like, and comment. Let me know what company you want me to decode next.